This street sign marks the epicenter of American financial power, and for 158 years, one institution stood out on Wall Street. Lehman Brothers survived the American Civil War, the Great Depression, and 2 world wars. These towering skyscrapers housed the 4th largest investment bank in the United States. By 2007, Lehman Brothers commanded a balance sheet managing hundreds of billions of dollars in client assets. This empire was ruled by CEO Dick Fuld, a man fiercely competitive enough to earn the nickname the Gorilla. Fuld cultivated a hyper-aggressive, win-at-all-costs culture where generating profit was the only metric of success that mattered. To maintain record-breaking quarterly profits and outpace rival firms, the bank began taking massive financial gambles. The conservative banking practices that kept them alive for a century were abandoned for high-risk, high-reward bets. That insatiable drive for dominance meant the executives missed a lethal threat right under their noses. They were actively constructing a systemic vulnerability into the core of their own operations. The trap was set in the early 2000s, when Wall Street discovered a new kind of financial alchemy. Instead of just earning interest on individual home loans, banks began buying up these mortgages by the thousands and converting them into tradable bonds. Take a look at this borrower profile. Lehman pivoted aggressively toward the subprime market, specifically targeting borrowers who had no business taking out a loan. They issued ninja loans, an industry term for borrowers with no income, no job, and no assets. Watch how these individual, highly risky red files are treated through a process called securitization. By bundling thousands of these toxic ninja loans together, Lehman magically rebranded them as solid, AAA-rated, mathematically safe investments. Lehman expanded their footprint by purchasing the subprime mortgage companies themselves, giving the bank total control of the pipeline, from the initial loan application to the final trading floor. Owning the originators meant Lehman was hoarding massive amounts of the very debt they were selling to others, guaranteed to fail assets disguised as safe investments. Notice the severe imbalance on this scale. Lehman aggressively leveraged its capital, pushing its ratio to an extreme 31-to-1. For every single dollar in actual physical cash the bank held, they borrowed $31 to buy more toxic housing assets. This simple foreclosure sign marks the breaking point. In 2007, the U.S. housing bubble popped, property values tanked, and Lehman found itself stuck holding tens of billions of dollars in real estate debt that nobody wanted to buy. To conceal this catastrophic loss from rating agencies and their own shareholders, Lehman's executives exploited an obscure accounting loophole known as Repo 105. Follow the movement on this balance sheet. Just before their quarterly financial reports were due, Lehman would temporarily sell $50 billion of these toxic assets to banks in the Cayman Islands in exchange for short-term cash. But look closely as the calendar flips. A few days later, right after publishing a spotless financial report to the public, Lehman would use that cash, plus interest, to buy them back. Going into 2008, the 4th largest investment bank in America was entirely insolvent, held together only by a legally sanctioned accounting lie. This plunging blue line tells the story of September 2008. The market finally caught on to the illusion. In a matter of days, Lehman's stock value evaporated, dropping by over 90%. Realizing the massive hole in Lehman's books, the rest of Wall Street completely cut them off. Rival banks refused to lend them a single dollar or clear their routine daily trades. Friday, September 12th, Treasury officials, federal regulators, and Wall Street CEOs lock themselves inside a New York boardroom. They have 48 hours to find a buyer before the Asian markets open. The clock is ticking. Federal Reserve Chairman Ben Bernanke, seen here, delivered a firm message. There would be no government money. With a taxpayer bailout off the table, potential buyers like Barclays and Bank of America immediately walked away. Sunday night arrived. The government had deliberately decided to let a 158-year-old pillar of the financial system collapse, believing it would teach Wall Street a lesson about reckless risk. At 1:45 a.m. on Monday, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. Weighed down by $613 billion in debt, it remains the single largest bankruptcy filing in human history. Much like this ice instantly freezing over a river of gold, the global reaction was immediate. Banks, completely paralyzed by fear that their partners were also hiding toxic debt, refused to lend to anyone. The global credit markets froze solid. On the chaotic floor of the New York Stock Exchange pictured here, the Dow Jones plummeted 500 points in a single session. The day the music stopped, an estimated $10 trillion in global wealth began to vanish. Beyond the trading floor, the damage reached the pavement. Lines like this one formed in cities across the globe, as millions lost their jobs, pensions, and homes in a matter of months. The dominoes fell, crushing the middle class. Yet the elite executives who engineered the subprime trap largely avoided prison, walking away with hundreds of millions in performance bonuses kept safely offshore. The ensuing global recession forced international regulators to rewrite the rulebook. Governments implemented strict new capital requirements, stress tests, and outright bans on accounting illusions like Repo 105. But you can't regulate trust. For millions of people, the sight of a century-old bank imploding overnight shattered their faith in traditional, centralized financial institutions. This vacuum of trust prompted a search for a financial system that didn't rely on the honesty of bankers. Just months later, the Bitcoin white paper was released, proposing a digital currency that replaced centralized institutions with a transparent, mathematical ledger. Lehman's 158-year history ended as a warning. It demonstrated that even the most established giants are vulnerable when their foundation relies on hidden debt and extreme leverage. The collapse of 2008 proved that when the complexity of the financial machine outpaces its transparency, the entire system can vanish in a single weekend.
Let's discuss that in the comments section. And as always, thanks for watching Alux Live. Subscribe for more.